My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. People make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate and teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Whenever you buy a stock, you need to exercise a certain amount of skepticism. Investing in a company requires multiple leaps of faith. Will the business perform as expected? Will the market behave itself? Will the economy do what you thought it would do? So how do you minimize the risk of disappointment? After a solid day, Dow gained 92 points, S&P advanced 0.07%, Nasdaq declined 0.05%. Let me tell you one trick I have learned in 40 years of investing for improving your odds. I like to rely on a brand, and more importantly, on proven management. When you have a CEO who implicitly represents a pristine enterprise, you dramatically increase your chances of a successful investment, maybe even a major score. Today, we witnessed the best example in living memory of how things tend to shake out when you combine an amazing brand with a tremendous leader. We saw what happens when you put your faith in the Walt Disney Company and its CEO, the always bankable Bob Iger. We learned their new streaming service, Disney Plus, the one that launched yesterday, already has more than 10 million subscribers. And that sent the stock up soaring more than 7%. Buy.
All aboard!
Ever since I first met Bob Iger, back when I was a lowly business commentator for Good Morning America some 23 years ago, I've recognized his leadership, creativity, and inspiration. He was very helpful to me. When he took over as CEO of Disney in 2005, right when Mad Money, the show began, I became a wholehearted supporter of the stock. Disney was one of the first stocks we recommended on the show, and it was also the very first stock I told you to buy and hold for your kids to learn how to teach, to get them to understand the stock market. Over time, there were plenty of moments that challenged the faithful. There's an errant movie now and then. Hey, some theme park weakness, we know that. And then, of course, the big one, the decline in ESPN subscribers. But that's when you had to put your trust in Iger's leadership. It's when you had to say, you know what? This is merely a bump in the road. Disney's such a fantastic brand that it's worth buying into weakness, which is what we did incessantly for my charitable trust, which you can follow along all our moves before we make them by joining the ActionAlertsPlus.com club. Now, if you believed in Disney, you have been amply rewarded. And you know what? I bet it's got even more upside, even after today's phenomenal run. A lot of price target bumps, we get catch some hold the buys. But that said, I'm not calling for blind faith here. That would be terrible way to manage your money. You need the right mix of skepticism and belief, enthusiasm and caution. You should certainly never be on autopilot because things do go wrong. But when Iger told us he had to take bold action to leverage Disney's incredible franchises, that it was time to go toe-to-toe with the Netflixes of the world and roll out his own streaming service, I said, now there's a chance to get a new group of people in on the ground floor of the Disney skyscraper. At the time, the skeptics were everywhere. Again and again, I heard that there was no way the new streaming bundle could make up for ESPN subscriber losses. They were too steep. I told you at least wait and see what the service looked like, for heaven's sake, but that it was probably worth owning, especially every time the stock traded down to the 100 and the 98 level. I said, buy. Then at Disney's analyst meeting in April, Iger laid it all out. You could get a huge library of content for $6.99 a month. Stock instantly vaulted from 116 to 130. Then worked its way all the way up to 147 in July before the skeptics once again took over and pulled the darn thing, sell, back to 128. But while Disney stock was getting hammered, I was reading Iger's autobiography, his book called The Ride of a Lifetime. And you know what? It made me realize that you absolutely had to own this stock going into Disney Plus. You had to own it ahead of the launch. Great brand, hard-charging CEO. I figured the new service was bound to be a hit. Yesterday morning, it finally launched. And most of the chatter revolved around the fact that the site kept going down. I told you this was what I call a high-quality problem. It meant Disney was seeing a lot more traffic than they'd expect. In an informal poll of people I associate with, I pegged the demand at maybe 5 million signups. Today, we got the real number. It's more than 10 million. That's double my prediction, and I was one of the biggest bulls out there. How did Disney do it? When I checked in with Iger today, he was ridiculously self-effacing as usual. He cited the company, the product, and comparable brands as the reasons they could hit that 10 million number. He said the signups, quote, speak volumes about the brand, adding that it's stunning. He did say it's stunning. Yep, even the CEO was shocked by the performance. When pressed, though, he emphasized again and again the power of Disney's brand. There's no doubt that their programming is a huge part of the streaming success, right? That's what's driving the service, and that success is extraordinary. As much as I admire Iger's humility, though, I don't want to lead you astray. So let me set you straight. First, the Disney Plus bundle, it was never a gamble. Iger explained to me that the real gamble would have been to just keep doing the same thing, letting ESPN bleed off subscribers while releasing mega hit after mega hit, hoping that one day his company would get the, benefit of that. Maybe licensing some of the content, the library, better to just try to make each quarter. No. It's better to cut out the middleman and monetize it directly. Second, only someone with the confidence of Iger would have seen around the corner to get this done. When BAMTech unveiled MLB.com right here on the show, I was blown away by the technology. At last, I had a way to watch out-of-market games and talk to my dad every time Ryan Howard or Chase Utley hit a dinger for the Phillies. BAMTech's technology was so special that Bob Iger realized it could let him build an elegant, exciting streaming service to compete with the likes of the Netflixes and Amazon. So he bought BAMTech, lock, stock, and barrel, and got it. Third, the only skepticism I had about Disney Plus was whether I needed the service myself. Now that my kids are all grown up, wrong. If anything, it's adults who are doing most of the raving. It's just like when I used to go to the Magic Kingdom alone when I lived in Florida as a young man. I've been there 10 times by myself and another 5 times with my kids, pretty much every time they got a new ride. One of the best times I ever had was when Pop and Mom took me and my sister Nan to Disney World when we were in our 20s. It was hysterical. Disney Plus, kind of the same deal, you know? Of course, there are plenty of other phenomenal CEOs out there, and I want to applaud them too. Today, Miles White, the incredible CEO of Abbott Labs, announced his retirement after 21 years running the business, the second longest tenure for non-founder in today's S&P. During that time, this guy created $220 billion in shareholder value. That's a total return of more than 575%. Holy cow, Miles White. Gold standard. Hey, just like Iger, Miles White repeatedly reinvented Abbott over the years. He's leaving the business in the hands of a worthy successor, Robert Ford. Oh, and with Apple rallying again, own it, don't trade it. New all-time high, up nearly 70% for the year. Would be churlish not to mention everything CEO Tim Cook has done for this great brand. But the bottom line, this is Bob Iger's day. This is a day where all of us who believed in Iger's leadership and Disney's amazing brands made out like bandits. Not long ago, Iger told me we're just getting started. And I say it's still not too late to join him on his ride of a lifetime. Let's go to Jamie in Massachusetts, please. Jamie.
Hey, Jim. Booyah.
Booyah.
Hey, my stock is McDonald's. We missed quarter 3 estimates and had to part ways with a great CEO. It's trading at 25 times earnings. Is it still considered overvalued, or is now a good time to add?
I think that, look, Mr. Easterbrook did leave. I think that the company with a 2.5% yield, a good balance sheet, and a terrific, I bet, Ken Chinsky, I've only emailed back and forth. I want him on the show very badly. Probably not the first time, not the time yet, but I love him to come on. I think he's part of a good bench. I think he really understood the technology that we're worried about. He understands America. He's going to do more around the world. It's a buy, okay? It's a buy. It's a senior growth stock. It's a buy. Let's go to Stephen in New York. Stephen.
Yeah, hi, Jim.
Hi.
With the sale of Symantec Enterprise Software and its name, I'm now a holder of Norton LifeLock.
Right.
A little NOLK. I'd like to know what your opinion is of it.
Oh, no, it's real good. I think it's an incredible franchise. The CEO is dynamite. I mean, really one of the smartest people around in the Valley, and I look forward to having them on out in Mountain View because they are doing such a great job. That is a great consumer brand, Norton LifeLock. A great brand. Let's go to William in Connecticut. William.
Hi, Jim Cramer.
Hi.
Let's go back about 7 years ago, 2012. I was watching your show like I do every night, and you were clicking some stocks, and you mentioned Teradyne, the symbol TER. It was $7 and change, and you recommended it highly. You said this stock is very low. I like it to go up in the 20s maybe in time. So I ended up that day buying it for $7.26. Today, it was up 48 cents to $65.66. And now it pays a dividend. The first 3 or 4 years I had it, it didn't pay a dividend. Now it pays a dividend. I didn't do a thing. I bought it. I held it for the 7 years, and I got the dividends now, and I bought a pretty good amount. Well,
Right.
what should I do? I never took anything, and I just held it.
It's such a good company. It is so good. Now, my discipline says that you have to ring the register and something. Why not do this? Why not take your cost basis out? Play with the house's money. It's a remarkable test and measurement company for a great industry, the semiconductor stocks, semiconductor business. I think it's fantastic. I've known it for ages and ages and ages. Just take your cost basis out. Let the rest run. It's really good. Okay, it pays to be skeptical and wary. But I believe the best way to minimize risk and maximize reward, that's the crucial part of investing, is to rely on a brand and the person who stewards the brand. Mad Money tonight. Shares in Dexcom just shot through the roof after reporting a solid quarter last week. Is this 30% move just the beginning? I've got the exclusive with the CEO to find out. Then I'm pitting the world's most expensive clothing rack, whoa, sorry, Lisa, against one of the cheapest gyms. Peloton versus Planet Fitness. May the best growth play win. And is there a bull market in the hospitality biz? I'm finding out from the CEO of a company that has a very high yield, Hersha Hospitality. Stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.